Hey, what's going on, everybody? It is Wednesday, September 29th. All right, we had a mixed market today. NASDAQ down. Actually, NASDAQ took out the low of last week. Folks, first let me just mention my new podcast episode is out, and the link is right here in the description below, so please go and check it out. I talk about the debt ceiling. I talk about these lowlifes at the Fed who were front running and then going out and making speeches, and they got caught red-handed and they're scum and they're out. I talk about possible default. I talk about mint the coin, the platinum $1 trillion coin, which I doubt is going to happen. But I would love to see that happen. I'll be honest with you. I would love to see that happen just to see the reaction and to once and for all neutralize and get rid of this ridiculous debt ceiling, which is a terrible impediment to running the country, and it's completely fucked up, excuse my French. Here's the thing, folks. Fiscal flows, I track those every single day, and they are slowing down. If you look at the year-over-year growth rate in spending, that is now growing at the slowest rate for the fiscal year so far. It's still growing compared to last year, but it has been slowing down, and actually we've been probably in a period of about 2 months where, it came down, then it kind of stabilized, and now it's starting to decelerate again some more. So that's a little bit concerning. The year-over-year nominal increase, it's still impressive, around 871 billion over last year, but that is the narrowest differential in a month. So we're seeing some contraction there. Again, it's still 871 billion over the same time last year. Total spending, by the way, is 7.7 trillion. That's a record. We're 871 billion over the same time last year. That is the narrowest differential in a month. So this is not like a precipitous contraction in spending. It's not like a fiscal cliff, falling off a cliff. Although if you look at unemployment benefits, that really does look like a cliff. I mean, I have one graphic of that where it's going and it's going, and then, as soon as that stuff really stopped in September, it went right down, right off a cliff. I mean, that is, just visually you can see that. That was a fiscal cliff, at least in terms of the unemployment benefits. But there's been other spending that has, let's say, kept the total spending flow from also developing into a fiscal cliff. So, having said that, I don't see the possibility right now of the market recovering its highs. I don't see it crashing down. But I do see it, in a corrective phase. We have seen some bearish sentiment increase. I mean, the put-call ratio yesterday was the highest since almost in a year, okay, since October 2020. So we're starting to see some negativity and some worry and some concern creep into the put-call ratio. Tonight we'll get the weekly AAII sentiment survey. I suspect we might see an increase in bearish sentiment there. We saw some 2 weeks ago. Then last week we got a little bit more bullishness came in. So again, this is all consistent, and I said this a few weeks ago when I said there's going to be a correction that brings the market back to a level that is more reflective of the fact that the economic growth is slowing down from 6.5% in the second quarter to 3.6 or 3.5% now. I mean, that's still a decent growth rate if we look back historically at the pre-pandemic, the pre-stimulus period, pre-pandemic period. that's kind of like the rate that the economy always grew at, 3.5%. The only thing is now it's taken a much larger amount of fiscal support to sustain a growth rate that was, kind of like a pre-pandemic growth rate, a pre-stimulus growth rate, whatever you want to call it. But 3.5% is still enough growth to support, corporate profits. The problem is when, companies see a decline in sales as the economy slows down, and when they see a decline in revenues, what happens? They try to cut costs, and that probably will result in some layoffs. And like I said a couple of weeks ago, we'll probably see a blip up in the unemployment rate. Now, we're not going to see the job number this Friday. It's October 1st, but we'll see it next Friday. And I don't have any forecast on that yet, but I'll give you something next week when it comes up. Now, the other thing that happened today, and this is kind of, it's kind of extraordinary what's going on with these reverse repos. The Fed did another record day. I think it was something like 1.42 trillion today. And like yesterday, it was like 1.35 or 1.36, like every day now. Like the banks are just, they're pushing the cash. They're not taking in those deposits or as many. It's going to money market funds, and those money market funds are stashing the cash with the Fed, earning 0.05%. This is really incredible what's going on. Yesterday, I don't know if I mentioned this yesterday, but Senator Elizabeth Warren said that Powell was the most dangerous man. He's a dangerous man, but it was Powell who foresaw the impact of massive reserve deposits into the banking system and the disruption that would cause. And that's why he proposed suspending the treatment of reserves in the leverage ratio. And then when that was about to expire, when that suspension was going to expire in March, and he wanted to extend it, right, to allow the banks to operate without the burden of, he knew all these reserves are coming in because Treasury was going to spend down its account. It had 1.6 trillion in its account at the Fed. It was going to spend all that down. Powell said no. Warren said no. Senator Elizabeth Warren said no. She said no. Reimpose that restriction. Reimpose that condition. So it's like she's the most dangerous person, not him. Because after they reimposed that restriction, that condition, what happened? Powell had to concoct this whole reverse repo situation to alleviate the pressure on the banks and the money market funds from this tsunami of reserves that were coming in. He kind of like saved the system from a GFC style crash that happened in 2008, like a Lehman crash. This thing, what he's doing, which is functionally like a reserve drain, okay, that's another thing. Like Treasury is not selling bonds because of the debt ceiling. Like he had to come up with this workaround, which he did, which is functionally like a reserve drain. But the whole thing is really, really messed up. One of the impacts of this massive RRP, reverse repos every single day, this drain, you're getting upward pressure on bond yields. All right. Today we had a little rally in the morning in bonds, and then it gave it all up. As soon as that reverse repo, that 1.42 trillion reverse repo happened, because that was a big, cash drain, draining out some liquidity. Number one. Number two, it's juicing up the dollar. Like you're sweeping a lot of dollars, you're sucking a lot of dollars out of the system, and that's just causing like a short squeeze. So we saw the dollar index today. I think it maybe hit like almost a 1-year high or something like that. Now I sent out a graphic today just kind of putting everything in perspective on the dollar, and it looks like, it's really, really like this massive bull move. But I mean, if you look at it historically, we're up like 5.5% in the dollar index since January. I mean, that's not like a big move or anything like that. It's a little teeny tiny. I mean, if you look at it, it's like a teeny tiny on the chart if you go historically. I mean, you can barely even see it. And you got to consider the overall underlying fundamentals of record trade deficits and fiscal deficits. I mean, those are conditions which, that's not bullish. I mean, historically, when you're running record trade deficits, I mean, the currency is going to follow downward. It might not happen in 3 months or even in 8 or 9 months. But it's going to happen. I mean, remember, we saw the dollar index last March at 104? And everyone said, oh, look at the dollar, it's so strong, king dollar, everyone, king dollar, right? And then it tanked down to 89, and now we're back up to 94. So you got to step back. You got to have some perspective. But a lot is going on, man. And then, we have to see what happens with if Congress is going to be able to pass a continuing resolution to avoid a shutdown. If we have a shutdown, we may see a further acceleration downward in those fiscal flows, or I should say a deceleration in those fiscal flows. And of course, right now, there's nothing in terms of raising or suspending the debt limit. Whatever workout they come up with to keep the government open by Friday, it will not include a suspension or an increase in the debt limit. And there's been a lot of talk now about the $1 trillion coin, but I really don't think that's going to happen, unfortunately, because it's just perceived from all these, very serious people right up to the White House that this is a wacky thing, even though, as I said yesterday, it is written right into U.S. code. That's Title 31, Section 5112K. You can go look it up. I mean, this is U.S. law. You can do it. Yellen can do it. Biden could ask Yellen to mint a coin, and that's it. We never have to worry about the debt ceiling again. But, they're just not going to do it. They're just not going to do it because they're going to be afraid of the criticism and the backlash and people calling it wacky and ridiculous, and we're like a third world country. We are already like a third world country with this, this standoff with the debt ceiling and how stupid we look. We are the only country in the world. I mean, there are some countries that have a debt ceiling, but they don't pay any attention to it, like Australia, for example, or it's put so high that it's like kind of irrelevant. But we're the only ones that have it, and we use it as a real constraint, and we use it as a political weapon. I mean, it's the height of dysfunction and divisiveness and destabilization. I mean, it's really fucked up. What can I tell you? It's terrible. Anyway, that's it for today. Don't forget to check out my podcast, everybody. The link is right here in the description below. Please like and subscribe. Thank you very much. See everybody tomorrow. Bye.